Good morning, ladies and gentlemen. Well, by my manual calculations, the risk dial is back to negative. It basically is oscillating between slightly positive and slightly negative, and I think that's all because of what the bond market is doing. It has been a relentless drive higher in yields, and I think it's probably best to concentrate on that this week, because it is driving every other asset class and every other spread. So without further ado, let's have a look at what the bond market is saying and what the various spreads and yield curves are saying, and then we can probably have a clue as what is most likely to happen with CPI and ahead of the meetings of the ECB followed by the Fed early next month. Well, the yield curve is really not doing very much in itself. But what is worrying is that week after week after week, we're seeing higher yields. The big development that I can see of last week is that while twos were roughly at 450% in the futures yield, threes have begun to outperform on the downside, i.e. you can see how now the market is expecting the higher yields to persist for even longer than they did before. So 11 basis points, say, in the twos, but something like 15 basis points in the threes. What is worrying to me is that this peg in the twos might not hold if we have a bad CPI. And then you have another 25 basis points at least to look forward to in the twos. And if that happens, the threes will go probably even more. And all this will go up, if not a straight 25, then a 20. So the danger to me next week is that this does not hold around the 4.5%, and it goes higher. And if it goes higher, you will see that the twos go at least 25 basis points and possibly even 50 basis points. And we start getting 5% rates, terminal rates being priced in the curve. And that is going to be just a wrecking ball for everything. Let's have a look at what the individuals are saying and what the spreads are saying, but it's very worrying, and there's going to be quite a lot of volatility if the number of in CPI is high. I just don't see any hope here. Right, so now into TradingView, where I've put in all the charts that you can follow. And this is a monthly chart that you can see here of the twos. As you can see, really, it just keeps on trucking. And really, there is really not a lot until we get to 499, i.e. let's call it 5%. And this is from a monthly point of view. What we have to do to restore any kind of stability in the bond markets is that we have to remain between this 370 and this level that we have here around 453 in the twos outright. Okay, this is not a future yield, but this is a simple yield. I'm afraid that we won't. If we have a bad figure, we will just jump to this 5% and basically have price in yet more aggressive hikes from the Fed. If we take this to a weekly, we just don't get any definition. We just have yields going higher week after week after week. I'm not even going to show you the dailies because it's absolutely pointless. There is, the trend is so strong that I just don't see any point in showing you anything apart from now if we go to the fives and we go to a monthly chart again so you can see where these levels are. these are levels that we last saw in 2006, and then basically in the late 90s and early 90s. And you can see that I really don't see any resistance here until 449 and then possibly 521. So you're talking about twos going all the way up to 5%, and then fives not stopping until 450. These are big moves. I just can't describe it in any other way. And if we go to the 30s, you are now talking still on a monthly chart to go between 394 and 419. A continuous wrecking ball. There's absolutely nothing that I can see in 30s until we get to 395 that's even worth thinking of fighting against. So I would say that the current trends of the stronger dollar and the pressure on the stock markets have to continue unless we stop that. So what is my game plan? My game plan is actually to buy some call spreads when if we achieve 395, and then see what happens. If it doesn't stop there, it's going to go straight to 419, 420. And that's all that can be said about this. This is an extremely powerful trend. I keep on expecting it to come back and retest lower levels so I can reload, but it's just not giving you that opportunity. And that tells me that this is a market which is still far away from equilibrium. The yield curve in the US is giving multiple warnings. This is the 2s, 5s. And it's a monthly chart, and basically it's never been more inverted. We're 23, 24 basis points of inversion, monthly chart. Again, this is as bad as things have got. If we start going through, I really can't see it not stopping until we get to something like 70. And that is the warning that I have. If 2s lose the anchorage, I mean, you've seen for the past couple of weeks, ever since I got out at 50 basis points on futures yield, the 2s have been basically stable. You've seen the futures price trade between 102, 13, 12 and 103. So basically roughly stable, while the rest of the yield curve has more or less kept going slightly higher in yield all the time. If now we lose the 2s anchor, you're talking about, as I told you, I think 2s go at least 25 basis points if we lose that 450 futures yield. So you go to 475 futures yield, which is something like, 445, 450 simple yield. And that to me will make this pop through and make everything go higher. The pressure will be again on the very short end, and that could be on the back of a CPI which is much worse than expected, and we possibly get a 50 basis point additional tightening priced in, i.e. we don't get terminal rates priced in the 4s anymore, but it's, let's say, 5%. That to me pops this much higher. What is the risk reward here? The risk reward here is to have some kind of a straddle, belong of a straddle in the 2s, because the 2s are going to move one way or the other. This either now comes back at least to these levels, to minus 11, or it goes to 70. I see no alternative. There is going to be no alternative to that. If we look at 2s, 10s, it's much the same situation. This is again a monthly chart. These are all monthly charts, and you can see it from here. We are basically as inverted can be. If we go through, that means that we're possibly going to 1%, okay? 1%, that's another 50 basis points. And 2s, 30s, again, nearly as inverted as it's ever been, not quite. We still got room to get to the 60s, to the high 60s, but that is also a warning. And if I go to the 5s, 30s, that to me is, 42, 43 to me is a good reaction place. And we got the reaction. We got how much? Oh, we got nearly 30 basis points of reaction from 42. But that really is not showing me any kind of reversal signs. You got to get some monthly red bars. And if I change this to a weekly, all it's done basically is it went through the Bollinger Bands. It came back to the Bollinger Bands to support, and it's now got the possibility to go and retest it. So to me, what it does next week when we retest 44 is going to be extremely, extremely important. For me to find that there is any hope that that we're going to hold in any of these yields, we have to have a bit of a yield curve which is steepening back out, and that can probably be seen best in the 2s, 10s. We've got to go and head back towards the 20s and then start breaking these levels for the yield curve to say, yes, we've reached the terminal rates. Unless and until we do that, I really don't see that there is very much hope, because every time we come back, we retest it, right? And it's just not feeling like the top. It feels like there's going to be a blow-off, and the blow-off can only come from the 2s making a big move. If the 2s make a big move higher, that means that we haven't had the terminal rate, that we haven't priced in the correct terminal rate, and when the 2s go, they go at least 25 basis points, and I would argue they go 50 basis points. So you're looking for terminal rates in the 5s, and that to me is as scary as hell, given how much pressure we have on stocks already. Things in Germany are not much better. This is the Schatz, the 2-year yield, on a weekly, but really tells us nothing until we look at the 1 month. You can see how important this level is. 190, 191. We got there last month, and these are the lows and the highs from April of 2011, and this is the low of July 03. If we go through there, the move is going to be at least 270. So at this level, I would have thought it pays to buy straddles, because either we're going to go all the way back down here, i.e. 109, 110, so that is a 90 basis point move on the downside, or a basically 80 basis point move to the upside. So the straddles are really not that expensive, or you just buy the puts if it starts going through, because it's going to go at least to that level. We have the we have the ECB at the end of the month. It's going, we are going to be waiting for it there if the CPI in the States is bad. There's to me, there's no question of that. If we have a look at the others, you will see how important it is. And don't forget, these are monthly charts. You're looking to be basically at least to 245 to 285 in the 5s, and the bunds, you can see how important this level is. It's the previous low and the previous highs. If we go through, we're going to 290. Okay, that's another 70 basis points in yield. And I think it's going to happen fairly quickly. It's going to happen in the course of 2 to 3 weeks. This is the kind of amazing, amazing volatility that we're likely to see, and it's unlikely to stop. If you ask me, we are probably going to go to 363 eventually in the bunds. And if you ask me, I have no hope that we're going to stop this trend before 268, or quite possibly these kind of levels, which are the 340s. So you're talking about big moves and the continuation of these big moves. And really, I would not be short of volatility for the life of me. If we look at what the yield curves are doing, you're having 2s, 10s in Germany at ridiculously high levels. Can we get to even higher levels around the 74 area? Yes, we can. I will fill in all these lines over the course of the next days and weeks. But you can see how the pressure is really not being absorbed by the yield curve. The yield curve has been basically doing nothing for best part of 2 years. We've been in a range between -11 and -70, so that's what, a 50 basis point move in the yield curve, which is nothing compared to what the yield curves have moved in the US. So you're talking about a ratcheting higher of all the yields in Europe, and really the possibility that is led again by the US. To tell you the truth, one of the reasons that I'm so afraid that the twos are going to go another 25 to 50 basis points higher in the States, i.e. we're going to get a ratchet up again in US rates, are these charts of the differential between the US and the German yield curve that you can see here in this watch list. Either we have reached the very top in differentials and now we go down to 2%, or we're going to go all the way back up to 285 basis points very quickly. I mean, there's absolutely nothing in between. So this is the differential between 2 years in US and 2 years in Germany. So absolutely nothing in between, and we will know sometime next week, because this trend is going to be very sustained, and it's going to go a long way. So what do we close? We closed here at 244. Okay, by the end of, say, next week, we're going to go either all the way back up to 275, or we're going to collapse down to 2%. Why? Well, because the CPI number is going to either completely anchor the twos again, or we will lose the anchor of the twos. It's, that there are no two ways about it. In which case we get a big move in these spreads, and I'm afraid that this move is going to be higher again, because I've been wrong basically to say all year that the spreads in Germany have to catch up because inflation is a worldwide phenomenon. It is, but these spreads are just not catching up. You would have thought that we would be a lot lower than we are in the twos. You would have thought we'd be at least down here to 2%, but we keep on stubbornly having this differential, this very high differential between rates in the States and rates in Europe. And this to me, this kind of pattern to me suggests that we are going to go and retest the higher levels. If we have a look at the fives, i.e. the bubble against the 5-year note, even that, it just keeps on ratcheting higher, a lot less fast, but it keeps on ratcheting higher. I think there's a very, very good possibility that we test this 229, 230 area again. And if we look at the differential between the tens in the US and the tens in Germany, you will see that this 153 level just does not want to be broken. And I am afraid that we're going to go and see higher levels again. If we get a bad CPI, we get a complete and utter massacre in the bond market. Because I think people have been fighting the bonds a long way. Fortunately, we haven't been fighting them nearly as much as a lot of other people. But we are getting to the stage that we could have people just throwing in the towel. Don't forget, we have QT next week coming back, and we have a lot of issuance next week. If these spreads don't hold, you're going to have double pressure. You're going to have the pressure from CPI. You're going to have the pressure from QT. You're going to have the pressure from the issuance. And you could have a complete buyer strike in the bonds. I'm really afraid of it. And if we just go and have a look at the US yield curve again, just so that you understand what I'm saying, this is this weekly chart tells you nothing, right? Where's it going to stop? You have to look at the monthly chart, and you have to say that you're not going to stop before you get to this level, which is, 5%. On a simple yield basis, that is another 50 basis points easy on top of where we are, i.e. we're going to be starting to discount rates, terminal rates in the fives. To me, that is very, very scary. Given the bond charts I've just shown you, and how the differential between the US and Germany is not coming in, and how I'm afraid that we might get a de-anchoring of the short end, it's not really surprising that the wrecking ball that the dollar is just won't stop. Every time we try the downside, there are buyers, and we go back up. I think the risk reward in the dollar is not to fight it, but basically to buy all the dips. And where do you buy all dips to? Well, I've showed you these levels. Every time it closes through 111.31, it goes to at least 116.17. And possibly to 118.55. It seems to be very simple that at this level you just don't fight it. You fight it once it reaches certain levels. That's where you take profit. But in the meantime, you're looking to buy dips, and you're continuing to looking to buy dips because there is absolutely no reason to do anything else. If we switch this to a view of Euro USD, to me this is as strong a trend as you can possibly have. It rallies from oversold through the Bollinger Bands. It goes back to the simple moving average, which is very, very strong, and it collapses from there. All it does, it alleviates the oversold conditions, gets the stochastics back into a sell mode, and boodoomph. It's just a pattern which continues. And really, I would not fight Euro USD until it's higher than these levels, 104 to 106. And on a weekly basis, you get even better levels, which is going to be these levels between 102.80 and let's call it 104.37. yes, 104.37. Until and unless it starts breaking through there, you're talking about a continuation of a very, very strong trend, and all you're getting is basically retests from below of very important levels, like just below 1. And that's all you're getting. You actually got a red candle. It's quite likely that we retest 96.67 next week and possibly go even lower. It's just a tremendously strong trend. And what that tells me is that the market is afraid of the same thing that I'm afraid of, and that is a de-anchoring of the short end in the US again after a couple of weeks of stability, and that the terminal rates are not going to be the ones that we have that we have penciled in, i.e. around the 4.5%. That's what all these charts tell me, that the market is afraid of it. Now, will it happen? Who knows? But the risk reward is still to go and push the market in that direction for higher yields, higher dollar, higher commodities, and basically no end in sight to this trend that we've had for the past 6 months. Well, what a big turnaround in oil. I mean, it was only a few days ago that we were trading and looking to test 75.16, and we got within a whisker and we turned around like a banshee, and now we will retest 97.77 at the very least, and 110.53 quite possibly. That is another reason why I'm worried about bonds, and that the bonds will react very negatively. If we look at DBC, and possibly we need to enlarge this, basically 26.93 was the level that I kept on saying is extremely likely to cap. It did. It came back down. We did a doji and we just continued on. I think the odds are next week that if CPI is strong, or even if CPI is not weak, we will test 26.93. And if we start closing above 26.93, I really think that we will test at least these levels, 28.40, which would give us oil probably well over 100, 105, 110, these kind of levels. And then we see. But it seems to me that there is not a lot of hope that we will not see at least 26.93. And that tells me that 97-ish is the minimum that we're likely to see in oil next week. I'm not touching gold, and I'm not going to touch gold for a long time, not until the trend in the dollar starts to weaken or the trend in the bonds stops. Because it just makes, gold is being supported by the other commodities, but it's being weakened by real yields and it's being weakened by the dollar. And therefore it's stuck in some kind of a no man's land. And it actually seems to be trading very well from technical levels. It got to the 1635 level, it bounced off. It tried to get to, how high did it get? Didn't get to 1764. To me, that is now the line in the sand. If it starts breaking through 1764, you're getting some relief in bonds, and you can get some relief in other assets. Until that happens, I think gold is indicating that there is no change in trend in the dollar, and therefore there is no change in trend in bond yields. And really there is no change in trend. There is no change in the narrative that we've been having for most of the year. And that is higher bond yields, higher real bond yields, leading to higher dollars, and a wrecking ball in all other assets. until that changes, until we start breaking through 1764 on a weekly basis, I really don't see any kind of hope for gold. It's just going to be stuck in the middle, pig in the middle, leave it alone, don't touch it. I want to show you one final chart which does not fit in with my fear of the twos becoming de-anchored next week. In fact, it says completely the opposite. It says that the bond market is likely to rally a whole load. This is copper gold on a weekly chart, and ever since it broke this 100 and let's call it 138 level, 140 level, you're getting a nice uptrend in gold against copper, indicating that you should be having a weaker economy and therefore lower yields. Now, I'm not so sure that our current inflation allows for the lower yields, and that might be why this is probably not a great indicator at the moment, and why bond yields are doing what they're doing while copper gold is doing what it's doing. But I think that if you start getting next week big moves to the new highs of gold against copper, you will start getting a reaction in the bonds. And that reaction can only be seen at the long end, really. It won't be seen at the short end unless you get a very weak CPI and everybody says, yay, the Fed's done hiking, we've got the terminal rate that we want. But even then, the twos really can't go all that far below the terminal rate, because the Fed still needs to get to it. And then stay at it for a long time. This, to me, if it starts breaking up, would indicate a continued flattening, i.e. negative yield curve, and things going very negative in the yield curve. And then it's quite possibly that I'm wrong and that it's not the twos that de-anchor, but it's the 30s that start rallying like crazy, because we get into a very, very bad situation with the economy. Those are the possibilities. I just want to show them to you, because this chart I don't understand. It doesn't fit in with anything else that I'm looking at, and therefore it puzzles me. And I'm trying to think of reasons why it shouldn't worry me. It does worry me, but it worries me less because of the inflationary period that we are in. And it could be saying that actually we are very close to a crack in the economy, but that would really need to be cross-referenced with what the S&Ps are doing, and I'm not really that negative on the S&Ps. Before I show you a chart of the S&Ps, let me show you something else which makes absolutely no sense to me, and that is the ratio between SPY and IWM. If the market was truly concerned that the US economy is weak and it's going to fall apart and earnings are going to be rubbish, surely it would be more concerned about the 1,500th company than the 200th company. Why is this chart looking so bearish to me? I.e. that SPY is going to go down more than IWM, or the other way around, that IWM is going to rally relative to SPY. Because if we start closing below this 211, and I'm being generous here, we haven't had a single weekly close. This is a weekly chart. We haven't had a single weekly close that was not very significant. Look at it here. We went and then we just collapsed. It could be the same thing, right? that we just collapse in SPY against IWM, and why would that be? Certainly wouldn't be because of higher rates, because they should hit the smaller companies who can't refinance, who are triple Bs, whose spreads go to the moon. Those should just become zombies. They should just disappear. Their equity price should collapse. And that is not what this chart is saying. I don't know why, but that is what I'm worried about. I'm worried about a big outperformance of IWM against SPY. And to me, that only happens during rally periods. This is the time that we had the outperformance. And this was basically when the all clear came that the economy was going to be strong and everything was going to be fine. And that basically stopped sometime in March of 21. A repeat of that would tell me that the economy is strong. I'm very puzzled by this chart. I can't understand it, but let's watch and learn. If it starts closing below 211, I think there's going to be a massive outperformance by small caps. Let's start by looking at the monthly chart of SPY. And really, very, very rarely does it close and not come back from the lower Bollinger Bands. We tried it last month, and that this is so far this month. To me, 3,500 is going to be extremely, extremely important, and I don't care what is happening all around me. I'm buying calls at that level. Are we still in a downtrend? Very much so. You can see that we always close well below these red or blue moving averages, and until we start closing above the red moving average, I am not going to be long. I'm going to be hedged, and I'm going to trade around my hedge, and that is all that's going to happen. But I think around 3,500, I trade long against my hedges. As simple as that. That is what I think. And even if I look at the dailies and the 195 minutes, it's all very orderly. Okay, we get to the top. We basically squeeze everyone. We get to the top of the Bollinger Bands, and we go back down. But this is very orderly stuff. It's not impulsive like we had here, where we just basically stay at the bottom of the Bollinger Bands for a long time. It's not. It's just sideways trading. I think if we see, just below 35.81 and we stop people out, you buy some calls, and I think it goes back to 36.40, 36.50. It's faffing around. It's not impulsive. And that is also what is worrying me in these charts, like the transports, which closed well off the lows for the week, in the IWM, which closed well off from the lows of the week, and also the charts of things like the Europe, which really closed nowhere. It really didn't do anything bad, and these to me are very important levels. 32.52, every time it gets there, I'm a buyer. But look where it closed, 33.74 compared to 32.52, and really the S&P's doing, coming back a long way. All these markets, just like last week, the small caps and Europe were saying that we are not in such a bad situation. All these markets are saying it again. We are not in such a bad situation. And the fact that the the SPY against the IWM looks so weird, something that you really wouldn't expect, tells me that the downside in the S&Ps has to be limited, and at some stage you are looking to buy them as opposed to sell them, and really that level has to be anything in the 3500s. That you see anything in the 3500s to me is a buy for a move back towards the 3700s, having, stopping everyone out in the 3600s. To me, that it's just a faffing around market. What would change it would be the CPI and the potential de-anchoring of the twos that I spoke about. That would put pressure on everything. But I'm not so sure that, the pressure will be that huge on the equities, because they're not really all that worried about the twos. They're more worried about the 30s. And that is, the only thing that really makes me think that we're not going to have such a bad week in equities next week. If we have a look at any chart in the risk indicators section, and I will add to them, and I will add lines and so on over the course of the next days and weeks, none of them are really saying that we are in a risky phase. SPY over PSCD, small cap, retailers, you'd expect this to be really moving like this if we were in a considerable risk-off period. SPY TLT, basically, hugging this center Bollinger Band, goes a bit above, a bit below, a bit sideways, but basically that line keeps on attracting it. That is not the stuff that huge risk-off moves are made of. SPY XLY, that it's come higher, but it's still on a down slope, as it were. XLP XLY, it's not really telling you that there is much risk here, and that is why I think that anything in the 3500s for the short term is a buy. All the risk parameters, all the risk indicators are telling you that SPY is going sideways. ITOT over government, it's just the totality of the stock market against government bonds. It's basically telling you that since the beginning of the year, more or less, stocks and government bonds have been tied at the hip. That is what this chart is saying. You get periods of slightly more fear, slightly less fear, but more or less they're tied at the hip. This relationship has to break. We have to start breaking above 409 or below 343 for either a risk-off period or a risk-on period to appear. We're getting neither. We're just getting whipsawed between levels. And to me, that says that the monthly chart of the S&Ps is right. Anything around 3,500 is a speculative buy via options, and then you see what happens. The only thing I'm afraid is that the 2 years spoil the party, and you get a very strong steepening of the yield curve. Now, maybe what the market is saying is that that might be enough to stabilize bonds, i.e. another 50 basis points discounted on the terminal rate stabilizes the bond market, because the bond market, i.e. the long end, that's what I mean, because the bond market then says, that's it. I mean, this is definitely going to do it. This is going to kill inflation. And then you might start getting some risk on from the IWM components, because they start discounting much better times ahead, and that could explain the whole thing. Until and unless I see this chart of SPY IWM doing something different than it is doing at the moment, I have to remain constructive for equities as a whole, as an asset class, at these levels. I mean, not higher, but at these lower levels, I have to remain constructive. Having said that, I've updated all the levels. I think next week we watch two things. We watch SPY IWM and we watch 2-year against 5-year and the spreads of the 2-year. Because if the 2-year stays anchored and we get a decent CPI, then everything else can do quite a bit better, I think. If not, if we de-anchor the 2-year, either we get a very, very strong steepening of the yield curve, which stabilizes the bonds, or everything goes to hell in a handbasket. So that is going to be those are the questions that I want answered by the market next week, and then we'll know how to react with each scenario. Thank you very much indeed, and tweet you tomorrow.